Good morning. My name is George Ankuma. I'm the lead partner for tax and regulatory services in Deloitte. And I want to especially welcome you all to Deloitte in Dialogue 2023. This morning, we are going to discuss some interesting topics. And so I wouldn't want to delve so much into it. I want to straight hand over to our senior manager, Wisdom Kwanu, who will take us through the topics to be discussed today, and then we move from there. So thanks so much for joining the session today. I believe you will enjoy, and you are going to have opportunity to ask questions, and then we'll take it from there. Thank you.
All right. Thank you very much, George. And good morning from my side to all of you joining us this morning. It's a great pleasure to welcome you to Deloitte's 2023 Tax Outlook webinar. And on this webinar, as we've done in the past years, we are looking to digest the changes to Ghana's tax landscape. And what better time than this time to discuss when we've had the budget read, and we've also had some amendments coming through with a few more to go. So as George introduced, my name is Wisdom Kwanu. I'm a senior manager with Deloitte's tax business, and I specialize in international tax. It's again a pleasure to have you join our webinar this morning. As you know, the Minister in charge of Finance presented the budget for 2023 on 24th November 2022. And since that announcement, we have had several discussions around what the implications are for some of the various fiscal policies that were proposed in that budget. Indeed, following from the budget reading, we've had Parliament pass a number of legislations. We've had the value-added tax amendment number 2 passed. We've had the Revenue Administration Amendments Act, Act 1086 passed. We've had the Electronic Transfer Levy Amendment Act 2022, Act 1089 passed, and they came into force by official gazette on 29th December 2022. We also have a number of bills that are pending, and it's the expectation that once Parliament resumes, those bills will be looked at and passed into law, whether with or without amendments as they currently are, is still to be seen. But on this webinar today, what we want to do is to digest these changes and how these changes in particular would impact the business environment and personal taxes, and how we structure our business, our activities, and be aware of various tax rates going forward. So this webinar is intended to identify the tax risk areas for 2023, where the changes are coming, and what we should be doing by way of compliance when we get into looking at the calendar for 2023, the tax and regulatory calendar. To have a deep discussion and conversation on these areas, I have with me seasoned panelists from the Deloitte team. We have Gideon Ayihowu, who is a partner with our tax team, being part of the conversation and providing insights across the various tax changes, the outlook, the fiscal outlook, and what we should be expecting. We also have Lovejoy Otre, manager with our Global Employer Services, and her area of specialization is in personal income taxes, employee mobility, and all advisory related to personal income taxes and mobility. And she is also on hand and would be giving us insights around the changes and around some of the key risks that we should be looking out for. Finally, but not the least, we have Joachim Owusu Efriye, also a manager specializing in the business tax area and customs, helping clients across these areas, addressing risks proactively and putting together risk management plans and policies to help clients handle their customs risks and corporate income tax risks. So my colleagues will be joining me on this call, and we'll be delving deep into the amendments that we are seeing coming, and in fact, providing our insights from our experience dealing with issues over the past years, as well as some of the major developments by way of tax cases that have come through. Before I go into the amendments, I will allow Gideon to give us a quick overview from a fiscal outlook aspect. What amendments, the amendments mean, what the GRA's posture will be, especially in the current economic circumstances that we find ourselves. So Gideon, if you're on hand, we'll take that from you and then we'll zoom straight into amendments.
Okay, thank you very much, Wisdom. And as you rightly mentioned, for the year 2023, we've seen quite a significant number of amendments and proposed amendments which are on the way coming. So as you rightly mentioned, we'll be looking at some of this and this proposals to discuss. And we also know that the tax is a creature of law. So aside this general or specific legislation, there has also been some a number of tax cases decided by the High Court, and this is also going to affect the businesses of taxpayers. And some of it, I must admit, do provide some clarity because these are questions that have been asked over and over again and we've not been able to get the answer. So this coming up this time, I think this tax cases will touch just on a couple and some of the areas which we think are quite relevant to our clients and taxpayers at this moment in time. So I'll be assisted by Joachim, and we'll be going through the amendments together, and then we'll also do the tax cases later on at the end. So please hold on, and we'll touch, and by the end of it, everybody will get something that would be relevant to their business. And I think one of the things I also want to mention is that because we are in very difficult times, we expect to see a lot more of tax audits ongoing. We expect to see a clampdown, a stricter enforcement of some of these regulations and legislations in the law. And so if there are other areas where previously had been unlooked, we do expect that it might not happen, those areas might not be overlooked in 2023. So strictly speaking, all compliance, timelines, deadlines, etc., we are to enforce the GRA. We expect that they will be enforcing them, and nothing will be taken for granted. We also know the amnesty period has passed, and so it gives them much more impetus, etc., to go ahead and make sure that they fully implement the law. So Joachim can start on the specifics, and then I'll be chipping in as and when we go along. So please, Joachim.
Right. So thank you very much, Gideon. As Gideon has mentioned, expectation is that there will be more scrutiny if there are areas of taxation that the tax authority has glossed over in the past. We are in times of economic crisis, and there are no two ways about that. And we have an urgent need to increase domestic revenue. And these are times that, as Gideon has mentioned, that we expect more scrutiny from the tax authority, more audits coming our way. And it's also the time that for us as businesses, taxpayers, various sectors, this is the time to up our tax governance mechanism and also ensure full compliance. So we'll go into the new amendments. As I mentioned earlier, since the budget reading in November last year, so we've had some amendments coming through, which we will discuss now. But also please pay attention that some of the proposals from the budget remain proposals. They have not yet been passed into law. So when we discuss the proposed changes from the budget and the subsequent bills that have been issued. Let's pay attention that they have not yet come into force. When they do, we'll surely inform our cherished clients and markets, and you'll be able to take action from there. But it's important that some of these proposals are in the offering, and we know them. So in the next few slides, we'll be looking at the amendments that have come through. As I mentioned earlier, in December, Parliament passed the Value-Added Tax Amendment number 2 at 1087, and essentially what this amendment did was to bring into form the proposals around VAT, chief among those being the increase of the VAT standard rate from 15% from 12.5% to 15% today as we speak, and that increase leading to an effective tax rate together with levies of some 21.9%. So that's almost 22%. Then we also had the introduction of penalty for non-compliance with electronic invoicing requirements. You would recall that last year in 2022, from October, there was an amendment that introduced the certified invoicing system, where suppliers, VAT suppliers, were to transition their invoicing system to this certified invoicing system in phases. And so with that, the current amendment has introduced specific monetary punishments for individuals, businesses that fail to sign up to this certified invoicing system, and this penalty is the higher of 50,000 cedis, or 3 times the amount of tax involved. And then also we had a revision of VAT exempt supplies reclassification, where now wager and in the betting and gaming space, the supply that used to be taxable is now an exempt supply. We'll look at the implications, and also we had some changes around textbooks that were hitherto exempted from VAT. So we'll look at the revision of VAT rates when this came into force. And Joachim, I'm happy for you to provide some insights around this. If this is in force already, what businesses should have done, and if there are still businesses that have not done updates to their systems, what the implications would be.
Okay, thank you, Wisdom. Once again, welcome to everyone for this very important session today. Yeah, so clearly the increase in the VAT rates, how does that impact business? How does that impact me, the individual, as a consumer? Obviously, it will affect price of goods and services in the markets. We all know that Ghana, we currently run 2 schemes of tax reporting. We have the standard rates and the flat rates. Flat rate suppliers charges VAT of 5%, VAT of 3%, and the levy of 1%. So that is why it's on the lower side. This amendment did not affect the VAT flat rate scheme, but only affect the standard rate suppliers. But it does have impact on both sides. So for standard rate suppliers, once you have the opportunity for input claim, then clearly the business in itself, in terms of VAT obligations, payments may not be affected, because if you buy and you get this additional tax, VAT, you have the opportunity to claim it as input. But under consumer, this is going to affect the final price of product to consumer. Flat rate suppliers are going to be impacted because typically they are going to buy from either imported products, or they will buy from manufacturers who charges VAT at standard rates. And because they don't have the opportunity to claim input VAT, it's going to form part of their production cost, which essentially will be passed on to the final consumer. So on all cases, it's going to affect compliance and businesses, we expect that since the effective implementation date was 1st January, if you are business that you have your own system that you implement, it's our recommendation that you should have done the changes in your system so that you can effectively charge the VAT of 15%. In case you also use the GRA VAT booklet, for now, the revised booklet have not been issued, but we expect businesses to able to do the manual adjustment on the face of their invoices. Just change the 12.5 rate to 15% and charge the right tax. Unfortunately, you don't have excuse if you don't do these changes, because penalties and interest may apply if you don't do so. We expect GRA in the coming years to improve, maybe issue the new revised VAT booklet, and I think we'll go into the certified electronic invoicing system. That the intention is to replace the manual invoicing system to have a centralized invoicing system that the GRA can monitor on real-time failings of businesses and how this could impact compliance. So that is also the introduced last year, 2022. It was expected that the implementation will commence in October 2022 on phases. Currently, we know about 50 or so taxpayers have been selected and they are going through the integration process. Not all the integration have been completed. It's a new system. The GRA will continue to learn from it, and hopefully, given the timeline they have given, the timeline for phase 1 implementation was up to 600 large taxpayers, which they estimated to complete by 1st quarter of 2023, commencing last year October. There are still a lot of work to do even within this 600. Phase 2 for medium-sized taxpayers, starting this year up to 4th quarter 2023, and for all other taxpayers up to end of that 4th quarter 2024. So, as I mentioned earlier, it's a new system. GRA continue to learn, but we always recommend that taxpayers will take steps to consult the GRA, get to understand the implementation requirement, the integration requirements, what IT infrastructure must you put in place to ensure that when it gets your time for implementation, you are ready for a smooth implementation. We know what happened somewhere last year where some shops were closed. It came to the public. I'm not sure any business wants to fall victim of that, because it damages your reputation and all that. So we always recommend be proactive, take steps to ensure when it is your time, you are fully ready for integration.
Right. That's interesting. So I think the key takeaways around the revision of the VAT rates is that the amendment came into force. The GRA has issued a notice making it clear that from 1st January, businesses are to recalibrate and charge the VAT. So if you have not done so, then you're already late, and it's important that you take immediate steps to correct that. And also the fact that the flat rate suppliers, there's no change in their rates, or at least on the output side. Flat rate suppliers will continue to charge 3% plus 1% COVID levy on their supplies. But importantly, there is still some impact because they typically buy from standard rated suppliers or imports, and they will be having a pinch of the increase to 21.9% VAT from what we used to have as 19.25. And your point on the certified invoicing system is quite instructive around the fact that this is being done in phases, but like every change potentially requires a lot of resources and assessment. So it's important that taxpayers are looking to be proactive, take readiness assessments, and reach out to the GRA or your tax consultants to make assessments and put in place the necessary resources to effect this change. So that's quite instructive to note. And then we also have a reclassification of wager or stake of any form in the gaming industry. So this is an industry that appears to be getting a lot of attention when we get to the income tax side. There are some proposals. So what are your thoughts around this for the betting companies now going to be exempt suppliers?
Yeah.
Okay. Yeah, I think for the VAT exempt supply, we know for VAT exemption, it means the GRA is taking this outside the scheme of VAT. And so what this means is that if previously they were charging, it means that they are no longer supposed to charge VAT. It's now an exempt supply. However, this has other impacts as well, and not just on the charging. For some of these betting companies, we know they are all related. They have related parties outside, and they have imported services. Right. And so with the way the VAT input applies, it means that this is now going to be an additional cost to them. It will lead to some additional compliance requirements for this betting and wagering entities. Then you can also look at the imported textbooks and educational materials as well, and that they've also been taken out. So this is an in and out. They've been taken out from the exemption list. And so it's quite an extensive, if you look at it in terms of foreign publications or magazines previously, which would have come without the VAT. Now they are putting them outside of the exemption, which means an additional cost, etc. It's also rather here, it means if you are in this sector, either you're an educational institution or etc., it also gives you an extra opportunity that you can start deducting input VAT, because when they've been taken away from the exemption list, now input VAT would apply. And so it's a give and take. You have to analyze your situation or your business carefully and then know what applies to you, whether now imported VAT is going to apply to you if you are in the betting or wagering industry or gaming industry. And then if you're also an imported materials for the printed materials, architectural, magazine, etc., this then now gives you the opportunity to start deducting your input VAT.
Right. That's well taken and quite instructive. So as you mentioned, it's a give and take. So if you are into import of textbooks and other materials, you are now a VAT supplier. You would have opportunity to claim, but with our levies, that also means that the consumers could expect some cost increase over them. And also for the betting industry players. So if you're a betting company, being an exempt supplier, you should be looking at what compliance requirements now that comes with, where you have payments for imported services. So that's quite important to note. We'll go on to the other change that we have had come through. Now we've had this benchmark value discount policy for some time. It came as a very interesting policy where the government granted discounts on general goods importation, and also we had a discount on import of vehicles. Now the DRA issued a notice, the public notice, that following the budget reading, government direction to abolish this benchmark value discount policy. And indeed, the notice made it clear that from 1st January, this discount policy has been fully reversed. I'm sure that this would cut across, because if we are looking at general goods and also vehicles, this will cut across in terms of impact. So you can help us to understand the extent of this impact. Companies are exposed to importation. Some deal directly in imported goods. Some would have their operations largely based on imported goods or input and other operations. So help us understand what the extent of this change would be.
All right, thank you, Wisdom. Of course, we all agree Ghana is an import-driven economy. So any change in policy that affects importation affects the entire economy. It affects every single person. The policy before the start of this year granted 30% discount for importation of vehicles and 50% discount for importation of other general goods. So what that means is that if you import general goods worth of $1 million, typically duties would have been assessed on the $1 million value of import made. But for the discount policy, you get 50% discount on it, subject to customs overvaluation. That is what we call the benchmark value. You get 50% discount, and then duties will only be assessed on the $500,000 value of import that you have made. So that clearly reduces your import cost by almost a half. So now that the policy is reversed, it means that we are going to see increase in import costs. Your import duties are going to increase. Remember, it comes with other taxes as well. It's directly impacts your VAT as well. So all these costs are going to increase significantly, and this we expect may potentially result in general increase in prices. So businesses should be aware of this, and if you want to stay competitive, you then have to assess your entire value chain. What can I do to reduce my cost of import? Given that now this cannot be avoided, full duties are going to be assessed on the value of import I made. On the flip side too, there have been a lot of calls for government to abolish this thing long time ago, particularly from the local industry, that it makes local production uncompetitive, because already foreign manufacturers enjoy some economy of scale, so they are able to produce at a lower cost, which makes import of goods a bit less expensive compared to manufactured goods. So now that this policy is reversed, we expect that potentially it will protect the local industry, and to the extent that they're able to manage other costs of production. Remember, it's not only imports that impact them, they're able to manage other costs of production. We expect that will also boost local production and the entire economy as well. So Wisdom, it affects everybody. I'm sure most of the things we are using now were imported. So we just have to increase our budget for our consumption.
Right. Okay. Right. It affects everybody. I'm sure that there will be businesses that are particularly exposed, and that's something that companies should be looking out for. I know we had some transitional provisions from the tax authority in the notice. Some would have been more relevant in 31st December. Just a brief on what these are and what businesses should look out for, or should have done, or should be looking at doing with this the transitional provisions that the authority came out with in its public notice.
Yeah, thank you. So I think it was very important. These transitional provisions were given as part of the notice that was published by the TNRA, because importation is a year-long cycle event. It happens all the time, and you clearly will have people who would have brought their goods at the port. The goods are discharged and ready for duty assessment. Maybe the duty assessment may not be completed by the effective date of implementation. What happened to those people? Are you going to say they are not going to enjoy the discount that was previously enjoyed, given that the goods were physically in Ghana ready for duty assessment? So it was important they created a window for storage-free period for such consignment to be assessed duty with the discount. So the reversal does not affect such imports. Then how Ghana duty assessment is done is largely based on self-assessment. So right. If you import products, you can go into the ICON system, make your own self-declaration. Tell TNRA, I have this consignment of goods that I'm bringing. These are the contents, these are the values. I want to declare this, assess me for duties, and I will pay. I will pay before the goods arrive. So if you have this arrangement, assessment made, and you have paid the goods, even when the goods does not arrive before 1st January, the reversal does not affect such importation. Right. And you may also have raised bill of entry, which is still a form of declaration, and is undergoing post-entry, but we don't expect any changes in the duties that is paid. Remember, the key point is that the duty assessed should have been paid at that time. Should have been paid before 1st January. So if the duties have been paid before 1st January, you don't suffer for it. However, if you have made the declaration of these goods, the duties have been assessed, but you've not yet paid the duties, the implication is that from 1st January or up to when the goods will arrive or when you are ready to make the payment, the GRA will do a reassessment, meaning they will take out the discount that you would have enjoyed on the previously assessments, then a new assessment will be raised on you for you to pay. So like the example I gave, if it was $1 million, duty was assessed on 500,000. Now they will reverse and assess the duties on the whole $1 million value of imports that came. So I think it was quite important that the revenue was able to issue these financial provisions to guide importers. Right. So thank you very much for that. So benchmark value discount policy fully abolished from 1st January, and the implications we have discussed. I know we had some self-clearing being introduced as well. Just maybe in a minute, some of the other key considerations around customs in 2023 that we should be looking out for very briefly. Yeah. So I think this is also another good initiative by the revenue. Currently, imports, if you want to make your importation, you need to engage the service of custom house agents so that they will interface with the DRA to do your declaration for you. So these are people who usually call agents, import or forwarding agents. They are solely responsible for ensuring that goods are declared from customs. This arrangement usually put taxpayers in difficulties, particularly because taxpayers usually don't have control over the entire process. They don't have control about what values are assessed. These are agents of importers. So whatever they do it on behalf of the importers. The importers are still ultimately responsible for the declarations made by the agents. So the agent give wrong declarations, and in a post-clearance audit, GRA can still reassess you based on the wrong declaration that was made. So this is the opportunity for businesses to take control of the declaration process, to be aware that these are the values I'm declaring, and it is correct based on the value of import I'm giving. It also provides opportunity for business to have access to their import records. This is a big issue in post-clearance audits. Usually, taxpayers may be access to additional duties because of lack of documentation. These agents don't work for only one person. They work for a lot of people. So sometimes they are not able to get all the import clearance information that you want to support your declaration. So this gives you the opportunity to have full access to your data. You know how to manage your import data so that you'll be always ready for GRA during post-clearance audit. So that's a very good initiative by the GRA. I just want to touch briefly on the custom guided trade initiative. Sorry, the AFTA. We know that let's do that. Yeah. AFTA has commenced. Effective is already effective because it's going through certain phases. Currently, just 8 countries have signed up to start the implementation. So countries with Ghana, of course, leading the way: Cameroon, Kenya, Rwanda, Egypt, Mauritius, Tanzania, and Tunisia. First consignment of goods traded under the AFTA was between Ghana and Kenya. So which shows the way that Africa, we are ready and we want to take advantage of this. It's good, and in the midst of economic challenges, cash flow issues, we encourage business to register with AFTA, get your rules of origin certificate, and once you get it, you are able to trade under the AFTA guided trade initiative with these countries that we are looking at. Again, Wisdom, just permit me to mention that the Afro that manufacturers. If you're a manufacturer in Ghana, there's an opportunity for you not to pay import VAT and levies. As we mentioned earlier, now the effective rate is almost 22%. So if there's any way you want to reduce your cost of imports, we believe that this is an area you just have to look at. Just take a few steps. Just be a member in good standing with the AGI, and then through that, make an application through the AGI, and the rest of the process can follow with the TRE. So it's a great opportunity. We have been existing in our laws, and we just want to highlight this now that it has become necessary for businesses to be aware and be ready to take advantage of all these things. Apart from this, there are other custom opportunities that will help businesses to manage their cash flow. And we just want to highlight the warehousing regime, for instance, is available to all. If you don't have all the money to clear your goods, why pay, or why go and borrow to pay all your duties? Warehousing is a suspension regime. They suspend the duties you otherwise have to pay now before you can clear your goods. Just clear your goods through a warehousing regime. Duty is suspended as and when you sell the goods from the warehouse. Then the duties, you get the cash to pay the duties off. At least you have up to 1 year to ensure that the goods are cleared from the warehouse. So it's a great opportunity for businesses to manage their cash flow, particularly given that now the discount policy is completely reversed and you are going to be assessed duty on a higher base. So businesses should take advantage of that. And there's also another key one that we want business to be aware of. Duty drawback is also there in our laws. If you import goods for manufacturing that you will subsequently export these goods outside, you are entitled for a refund. That's what we call the duty drawback. So you just have to be aware of this, putting in sufficient documentation. I know a lot of businesses import, process, and export. Are we taking advantage of these opportunities that exist in our laws? So businesses should be aware of this and ensure that they take advantage of this. The last thing I want to mention is that if you look at your import assessment, there's a line that we call IRS tax deposits. This is a 1% tax, income tax that is, withheld upfront. So 1%. Now, businesses sometimes maybe are not even aware these taxes are income taxes they are paying, or are not even aware they can even avoid paying this tax at all. Simple process. Just ensure you provide your thing. It only requires that you provide your thing to qualify not to pay this 1%. We believe that this is also a great opportunity that businesses can consider to manage their cash flows. Right. Thank you very much, Joachim. I think it's clear that it's not all grim, and of course, especially in these times of high cost, high inflation, and additional taxes coming our way, we cannot be losing sight of these opportunities, and we'll be happy to engage taxpayers, assess opportunities and qualification for some of these opportunities to save on cost and, of course, on cash flow. Just a reminder that you please put your questions in the Q&A chat box. We'll also have some time close to the end to allow for live questions. And we've had one come through that I would want us to address before we even move to the next part of the discussion. This I would ask Gideon to address. So we have a question from an anonymous attendee asking around, with the exemption of betting companies from VAT, whether these companies can go on to deregister from VAT, and also what happens to credits that they have accrued in the past prior to this
legislation coming into force to exempt their output. So, Gideon, your quick thoughts on that, and then we can move to the next slide.
Okay, so I think the answer to that is that whilst we await for any guidance or clarification, especially for the betting industry, what I'll say is that having recognized that you have any credit from GRA, you should hold on with any deregistration. We should first of all have to look at where the credit is arising from and whether or not you are doing a refund of VAT, or whether you have to do an offset of VAT against any taxes applicable. So in your case, I think I would advise that you contact your GRA office and ask for an audit to come and confirm your VAT credit first. And then afterwards, it's likely that you might get a set-off of this VAT refund if it's confirmed by the audit against your other taxes applicable.
Right. Okay, so thank you very much. You tread with caution and open communications with your local office. Gideon, thank you very much. So we'll go on and please keep your questions coming. As I mentioned, you would also have the opportunity for live questions. And keep your Q&A and other comments in the Q&A chat box. So we also have the Electronic Transfer Levy Amendment Act 1089, which I believe by now we are already enjoying the reduction in e-levy, so we would know. And as you may have heard from the budget reading, the government proposed to reduce the rates from 1.5% to 1%, and that has since been made effective through this amendment Act 1089. But then important to note that contrary to what the budget proposed to take away the daily threshold of 100 cedis for mobile money transfers and 20,000 for bank transfers, the final amendment Act retained this threshold, or it did not change the threshold. That means that the threshold remains, and we are also aware that the implementation has by a letter issued to the charging entities allowed the reduction in rates to be effective from 11th January 2023. So we should by now be seeing the reduction in the e-levy rates from 1.5% to 1%. If you still see any charge that is more than 1%, please reach out to your telco. The Ghana Revenue Authority has made clear that where you are overcharged, you have the right to refund. So reach out to your service provider, lodge your complaints, and once it's investigated and confirmed, you would be able to have refund of any overcharges. We'll go into the proposed amendments and look at what have been proposed. And as I mentioned earlier, the proposals came from the budget in November 2022. We had some acts and legislation being put together before the end of the year, and that those ones have come into force, which we mentioned. The benchmark policy was by way of a public notice by the Ghana Revenue Authority that has also come into force. For these proposed amendments, they are still yet to come into force because Parliament is yet to pass these ones. We expect that once Parliament resumes, these will be assessed and passed, whether as they are or with some amendments. So broadly, from a personal income tax point of view, the major change that we have from this angle is that we have a new tax band. So currently, up to now, because this has not yet come into force, the top marginal rate is 30%, but the proposal is to take this to 35%. And this band you see on the screen is as per the bill that the Finance Ministry has issued. So we are going to have 35% as the top marginal rate on chargeable income exceeding 50,000 cedis monthly and 600,000 on an annual basis. This may sound high, but what does it mean for us as individuals? Our pockets are net pay for the business environment and for our attraction of experts coming into our space to work. So I have Lovejoy, who will take the next 2 minutes or so to speak to what this potentially would mean for individuals and also for businesses. So Lovejoy.
Okay, thank you so much, Wisdom. So as Wisdom has actually highlighted, looking at the rates on the screen, so the proposal is now taking into consideration the minimum wage. So for the annual figures that I will deal with, it's now 4,824, obviously, as we see on the screen. But between the nil brackets up to the 25% brackets, sort of, you see there are no changes in the income brackets and then the rate. But because of the introduction of the minimum wage in here, you see that on an annual basis, if you are earning income within this range, there's going to be a tax saving of about 22.20 Ghana cedis on an annual terms, which is equivalent to just a cedi and 85 pesos on a monthly basis. So this is what we have to look at if this should be passed into law. But the switch here again is that from the 30% bracket, we see that there is an expansion in the income bracket. So instead of the 240,000 that we are currently using, it has been moved to 359 approximately. So now if you are a salary, if you are an individual and you earn in excess of 240,000, but you don't exceed 359,000 Ghana cedis, what's going to happen is that you are going to remain in the 25% bracket instead of the 30 that you used to pay taxes on, which is a tax saving point in there. But as outside of this, the government has introduced 35% tax for people or individuals who are earning beyond 600,000. So if you look at the analysis here, what it means is that government is targeting high earners. So if you are an individual who is earning beyond 600,000, instead of your topmost margin remaining at 30%, it's going to move to 35. So you're going to suffer an extra 5% tax on your earnings going forward. We are just waiting for it to be passed, as you mentioned. So for now, we are using the current rate until it being passed for us to know the effective date to apply this rate.
Right. Okay. That's well noted. And there are some other amendments, especially relating to the quantification of vehicle benefits. Can you share some light on that as well?
Okay, so just to also highlight from this point, the tax cash emolument is the vital aspect of this discussion. So just to highlight that for the basis of this valuation is centered on your total cash emolument. And your total cash emolument is your cash benefits and other cash benefits that you receive from employment. A total of that is what we are talking about now. So now if you are receiving a vehicle benefit in terms of coupon, or you are given a car or a driver, what the law is saying in option 1 is that we are calculating 12.5% on this TC that I've explained already. And if we are getting anything beyond 1,500, we are going to cap it at 1,500. Similar understanding transpires in option 2, 3, and 4. So over here, what we are saying or recommending is that now taxpayers should compare the actual benefit they are giving to individuals in relation to what the valuation would be if they should use this percentage on their TC. If obviously the benefits you are giving to the individual is way lesser than the valuation, it would be advisable to give the benefits as an allowance to go through a graduated rate rather than going for the benefit in kind, obviously. So this is the another area where, should it be passed, employers should sit down to analyze and to take tax saving measures from this implementation as well.
Right. Thank you very much. So other changes from a personal income tax point of view, as per the proposed the bill that we have, which is a proposal to make amendments. We have the tax waiver on withdrawal from Tier 3 funds, which we saw during the COVID time, where government supported with tax waiver, where you withdraw from your personal pension schemes, so the Tier 3 provident fund. And then also this second point is of interest, so that's where I would say that you make a note on revision of the optional 15% tax rates for resident individuals. The proposal to revise this to 25. So what's this about? What's this revision all about?
Okay. Okay, so currently, we have an option to elect to either tax your investment assets, like the return, the realization on it at 15%, or allow it to go through the graduated rate. So this option is what has been revised. So instead of 15%, is now being revised to 25%. So in the past, 15% looked like a small value, so people would always elect for that 15%, but now it's 25%. I think taxpayers should look at their income line to know their topmost margin before making such a decision. That's basically what the revision is actually about.
Right. So individuals with the option for 15%, with this change, that means an increase, right? An increase to 25%. So reduction for a reduction of net pay or net income, where individuals even opt to elect for the flat rate on investment gains. We also have proposals that would affect businesses that would want to quickly highlight, and we will highlight these in about 4 or 5 ways. So we have the minimum chargeable income system that has been proposed, which is a novelty proposal to have 5% notional tax, if you like, on turnover for businesses that make losses for consecutive period of 5 years. So this will, if it eventually passed, will be novelty in our tax system for businesses that continue to make losses, having to pay 5% of turnover as minimum tax. So that would be an area that businesses would have to assess. And also we have the unification of tax carry forward losses, carry forward of tax losses. We currently have businesses in other sectors and then priority sectors having 3 years deduction and 5 years deduction respectively. The proposal is to have all businesses deduct losses for 5 years. So that's the proposed unification, which would be good news, especially for businesses currently under the 3-year loss carry forward regime. Then we also have a proposal to revise the temporary tax, so the concessionary tax paid by entities under the temporary concession. Currently, it's 1%. So if you have an exemption for say 7 years or 5 years, the companies or entities pay corporate tax at the concessionary rate of 1%. The proposal is to increase this to 5%, and in the budget, in the budget reading and the memorandum to the bill, this is to lead to an eventual abolition of this concessionary rate in future. So if the law is passed, then entities that are currently on 1% because they are in temporary concession period would have to now pay 5% corporate income tax. And there is also an introduction of a tax return and withholding tax for capital gains. Again, currently, what happens is that businesses where they realize assets, there is no specific withholding tax on certain capital assets realization, like land, for instance, which has been an area of debate. The proposal is to introduce a 3% withholding tax for payments of said assets to resident persons and 10% for non-residents, and then return to be filed 30 days after the realization. So if again the proposal comes fully into force, then businesses would have a return to file if they make a realization, and also those paying would have a withholding tax obligation, which has not been so in the past. And then we also have the restriction on deduction of foreign exchange losses. That the proposal is that whilst we currently under the Income Tax Act 896, businesses are allowed to deduct foreign exchange losses, whether realized or unrealized, by operation of Section 25 of 896. The proposal is to restrict that deduction to only when the foreign exchange loss has been actually realized. That's where you have actually made payments for the amount payable denominated in foreign currency, and that would mean that businesses will not be able to deduct unrealized losses. So a plethora of changes, at least on this slide, we have about 5 that have been proposed. If these come into force, largely businesses will have their own exposures here, but then also would have to think around how this impacts them. So Joachim, maybe I'll say you speak on the foreign exchange loss restriction, and the unification of tax laws is what businesses should look out for.
Okay, thank you. How the proposal is couched now, we expect that it's going to impose a lot of reporting obligations on businesses in terms of their accounting, booking, and all that. So now, in fact, there's an expansion clearly from the proposal to include foreign currency holdings. We are suspecting that because of the last year issues of the dollar, the CD depreciating, people trying to get to hold foreign currencies, which in the current law, that is not specifically provided for as a financial instrument that may be subject to this restriction. So there's an expansion. So if you have a dollar account, or you have any foreign currency account, any revaluation of that account you do will be subject to this restriction. So that is very key. Foreign currencies or exchange law that you get on assets. In the existing law, the law allows for deduction of, even if where it's of capital nature, the law allows deduction for it, subject to the restriction. But now, strictly, it will not be considered for deduction. So capitalize it and get deduction through capital allowance. And the interesting part for me is the last bit of this proposal, where it's just going to be limited to local transactions would not be considered. Foreign exchange losses on local transactions would not be considered. This is to reiterate the point that businesses generally are not allowed to trade in foreign currencies in the country. So all local transactions generally are not, but there are some local businesses that can get authorization, for example, from the Bank of Ghana to trade in foreign currencies. So the question we ask is that what happened? Because they are also local entities, but they are also right to trade in foreign currencies. What happened to such foreign exchange losses that may arise. So in terms of reporting, businesses then are expected to ensure that they properly characterize their foreign exchange losses. So first, ensure there's proper recognition of realized and unrealized. That is one. Then two, part of the, now unrealized is not considered. So the part that is realized, you have to be able to distinguish between what is of revenue nature, what is of capital nature, what relates to local transactions. You should be able to distinguish between these three to allow for easy tax assessment on this. So that's what I want to say on that. Unification of tax losses, I think, is a good news for businesses who were previously under the 3 years. But again, the concern we are raising is that what is the count? Is it just going to apply to new losses you incur from the effective year of implementation? Or if, let's say, you have a loss in 2021, which either to be 3 years, which will end 2024, can we extend that loss to additional 2 years to enjoy 5 years? So we expect maybe some notes from the GRA to maybe provide more clarity, or maybe certain input will be considered so that the law may be redrafted, and when we get the final one out, some of these questions may be answered. Just a little bit on the minimum chargeable income system. As you mentioned, it's novel, and for instance, we go to Nigeria operates within this system for a long time, and their approach is straightforward. They also give some minimum years of redemption for all businesses, and after that, everybody have to pay. So the intention is to ensure everybody is paying tax. Everybody is paying tax, and it's on turnover. So you can imagine the impact can be significant. So right. You're a business that you've not been paying tax for a long time, but you can look at the extractive sector, who, because of the exploration phase, exploration development phase, they incur significant cost during that phase. And sometimes it can take longer years before they get into production. So they are in this process, they are making losses. Then when they start production, 5% on turnover. We think that is huge, and maybe we expect that there will be further negotiations, discussions between the extractive sector and the government to see whether certain concessions may be granted to them. Right. Thank you very much. I'm already seeing a lot of give and take, as Gideon mentioned earlier, and also you also strongly see the burden sharing theme, where now more businesses are paying more taxes, and then also we have the growth and sustainability levy. The growth and sustainability levy, and I look at the table and it seems almost everyone is on here. Joachim, what's all this about? Yeah, I think growth and sustainability levy. Exactly. We have to rebuild our country, all of us together. Right. So all businesses are now going to look into the growth and sustainability levy. Existing levy is National Fiscal Stabilization Levy. That's just 8 sectors were paying, right? 5%. 8 sectors were paying, but right now it's expanded to include all businesses based on the categories. So category A, about 13 sectors are listed. Category B is the extractive sector, mining and upstream oil and gas companies. And note that is 1% of their gross production. That can be very significant, right? We know there are concerns around their stability clauses in their respective mining license or petroleum agreements that potentially the government may be trying to abuse that. So those bigger questions are being raised. We believe, and we know certain discussions are ongoing to see how this particular thing can be implemented. Of course, businesses in these categories are worried, and we expect government to continue to engage in this area. And all other businesses, or if you are not within category A and B, then you clearly fall within the 2.5% bracket. The last thing I want to mention is that the bill states that these are entities. So what happened to sole proprietors? Are they also included in this burden share, or they are specifically excluded. I think we expect more guidance from the GRA before the implementation commences. Right. Okay. Right. Thank you very much. All entities, growth and sustainability levy. Gideon, you have a comment?
Yeah, I think a comment on the proposed, in this section of the proposed amendments for the concessions, and then also for the fiscal stability levy, which has gone to growth and sustainability levy. I think we are hoping that maybe before these laws become effective, there will be a bit more deliberations or with affected parties, because it's going to increase. Of course, there's a need for additional revenue, but it's going to increase the effective tax rate for all taxpayers. And then especially where the questions are around, especially for the concessions, we talk about agriculture, etc., that they've been paying 1% of chargeable income all this while, and all of a sudden it's going to 5%. Are they also going to be affected here? Because there's a category C, which is capturing everybody. I think we need a bit more guidelines or specification in the law so that certain entities would also be excluded from this all other categories. C, category A has already been there already, but with the additional ones of the B and C, it might need a little bit more of deliberations with affected parties. Right. And for another point of concern is that on the temporary concessions, I know this is still a bill, but when you look at the memo under which you went to Parliament, it talks about the fact that these concessions are gradually going to be phased out. It's not part of the law, but it's also for somebody who is in the sector. All those entities, we mean farming, agriculture, residential or waste processing, all those who have been benefiting from these temporary concessions will then be jittery at this moment, because looking at it, it is not going to last forever. Even the 5% now is on shaky grounds. Eventually, they might see further additional increments here.
Right.
Wisdom,
right. Then those sectors are key.
Hello, Wisdom.
Those sectors are key. Yes, George.
Yes, if you may allow me to come in briefly to add something to what just Gideon said regarding this growth and stabilization levy. I think it's also important that we know that some companies, especially within the oil and gas sector and the mining sector, have specific stabilities or agreements with the government of Ghana. And so with this introduction, definitely there will be some discussions or negotiations as to these companies, whether they will be included in the payment of these taxes or not, because they have agreements which does not allow for any additional taxes. But then I believe that some negotiations, and I'm aware that some negotiations have already started around that sector. And so by the time the law actually comes up, I believe that there will be some clarities around businesses in those sectors that have specific exemptions in the agreements.
Okay, right. So businesses with fiscal stability. Right. Thank you very much. Still some more proposed amendments, as I mentioned earlier. The betting and gaming industry is seeing a lot of attention, and this is not a surprise because the GRA has already mentioned that a unit has been set up to review this sector, and with the proposal coming through, the proposal is that from an income tax point of view, gaming and betting companies would have a 20% income tax in lieu of their corporate tax on their gross gaming revenue, and that gross gaming revenue would be the total amount of stakes that they take less winnings. So if this comes true, it means that gaming businesses or companies in the betting and gaming sector will now be paying a corporate tax, something at the top level indicator, and not the taxable profit that we have for the general sector. And this is something that anyone in this space should pay keen attention to, in addition to the VAT proposed VAT
change, the VAT change that has indeed already come into effect with the VAT Amendments Act, and also payment for winnings from lottery to be subject to final withholding tax of 10%. So again, businesses operating gaming and lottery business would have to now withhold 10% from winning payments, and that would be final for the persons that win from this betting and gaming space. So this is part of the proposed amendments currently in the bill, and once Parliament puts this into effect with presidential assent, the changes will come through, or whatever additional changes that may come through as this is being reviewed in Parliament. So very important for us to take note of. We'll go into our session. So with all these changes, we'll go into our session where we highlight so the question around, with all these changes, where do we see the tax rates? As Gideon mentioned earlier, we have to now situate any discussion around tax compliance, tax governance in the context of a country that needs to raise domestic revenue, which indeed we have to, with our 13.5% thereabouts tax to GDP. We have to raise our tax revenue. For businesses, it's important that we are identifying the risk areas and closing any risk gaps, so that we are paying the taxes, our fair share of taxes, and not exposed to interest and penalties. So we'll start off looking at some of the, with all the happenings from past years, audits we've been engaged in, tax cases that have come through. Some of the key risks 2023 you should not miss and you should not fall foul to. So we start off by looking at these three, and Joachim, I would invite you to again to speak to these 3 points as part of where the risks are and what we should be looking out for.
Okay, so thank you. So entities, branch, when foreign companies want to set up here, they have option to decide which entities that they want to register. And typically, they will register external companies, which we generally know as branch offices, to represent them, maybe provide some short-term activities on their behalf. How branches or external companies are taxed are not entirely different from how general subsidiary companies or limited liability companies are taxed. But when branch make profits, there's a requirement that this branch will pay what we call repatriated profits on whatever net profit they earn whilst they operate in the country. So if you take certain sectors that there are stability clauses that protect companies on how much tax they can pay, particularly if you look at the petroleum sector, where their PAs provide certain specific rates of tax that they will pay, and stability clauses lock those rates. Subsequent amendment law does not affect those rates. Then it becomes a challenge. Okay, is that the only tax they have to pay, or there are additional taxes that we can use subsequent regulations to pay? I know there are support cases that this particular issue went to court, and there was a judgment on it. I know we'll go into the cases, but it's an area that we want company to be aware of. If you have branch operation, remember, after you pay, the branch pays the corporate tax of 25%, there is an extra 8% branch repatriated profit that have to be assessed and paid to the GRE. A lot of branches, as we know, may not be aware, and this is an area I want to highlight because it has been an area of litigation that the court has pronounced on. Now, the big issue for us in 2022 was in respect of trade discounts. Discounts, have not been a big issue in the past until the GRE maybe took a view to scrutinize discounts, subject discounts to the strict application of the law, the tax laws in Ghana, and companies who were considered not to have applied their discount policies to the full settlement of the law have seen their discount policy recharacterized, for instance, recharacterized as commission and being subject to tax, withholding tax on the commission. The main risks have to do with how you account for the discounts. When you account for the discounts, you should account for the discounts if discount is given on transactions. Then when you are issuing your VAT invoice, ensure that discount is being accounted for on your VAT invoice. Post-invoice discount can also be issued, but how do you account for it? There are specific rules around how you can account for post-invoice discounts. The law provides specific provisions on how you can issue a credit note to ensure that the discount is properly accounted for. Anything other than this, you subject your business to significant risks, especially if you're a large company that have discount policies across and it may be significant to the revenue you make, then you may be subjecting your business to significant risks of potential recharacterization by the GRA. Another issue that has been contention for a long time has been withholding tax on payment to HR service providers. These businesses sought for qualified personnel. They have them in stock, or businesses who want to employ because maybe they don't want to take the responsibility of tax filing, contract negotiation, slate payments. They go through these HR service providers for them to sort for staff and then give secondary staff to these companies. Now, these HR service providers and their income, less than a percentage of whatever salaries you pay to this personnel. When they issue their invoice, it is the cost of this staff, which is their salaries and their management fees. The issue has been that should withholding tax apply on the entire invoice value, i.e., the salaries plus their commission plus their management fees, or withholding tax should only apply on the management fees. These two positions have been held, depends on maybe who you meet on the tax audit and how you argue your case. In some instances, we see the GRA accept, an explanation that, hey, these salaries, POI have been paid on these salaries. So to subject these salaries to additional withholding tax, that would be double taxation. So exclude. In some instances where you are able to show that indeed the POI was paid on these salaries, it depends on the team, but it wasn't the general practice that this team may accept not to apply the withholding tax on it. And there are some teams who will take a very aggressive position, a stricter position of the law, and say that the business of these people is to supply staff. And supply of staff is an activity that you do. So withholding tax is not applied on the profit you make on these activities. It's applied on your cost plus profit. So then withholding tax should apply on the total invoice amount. So this has been an issue of contention, and it's good that now we have case law to settle the arguments, and it brings more clarity to businesses who make a payment to these HR service providers. So this and other general compliance risks, documentation, we always talk about it, how you account for your VAT. If it is relief, put it under relief. Don't put it under standard. If it is exempt, put it under exempt. Don't put it under any other column. Because if you don't properly record it well, then it will be subject to other interpretation, which may, expose the business big time.
Right. You're right. Thank you, Joachim. Very key risks: branch profits, dividend, tax withholding. Sometimes businesses miss to apply the withholding accordingly, and then the trade discounts. Again, we'll delve a bit into that and look at that in the real world scenario. Withholding tax on payments. I know. So all this discussion, there will be something around what the documentation should be and all that. So, Lovejoy, any comments, inputs on the HR service provider aspect and what sufficient documentation would mean?
Okay, so for HR providers, those outsourcing contract staff to companies, So now for the company who's receiving these contract staff, in the past might not be concerned with what the PAYE issues were. But with this judgment and with this case, it's obvious here that you should be concerned with the PAYE of the contract staff and make sure that on monthly basis they are filing and making the right payment, because that will be the documents that you would need to support the argument when GRA should come for an audit and to say they want to withhold on the reimbursable amount. And another caution that I think we'll throw in here is the fact that when raising such invoices, I think it has to be split into service fee and then the reimbursable, which is the cost of staff, so that it's clearly seen on the invoices that this is what relates to the service and this is what relates to employee cost. And a lot of reconciliation has to be done, both at the outsourcing agent side and then the company receiving these contract staff, making sure that on a monthly basis, the cost, the staff cost reconciles with the returns and the payments made, so that it's quite easy during audits. There are a lot of documentation that has already been done, a lot of reconciliation that has already been put together. So when the GRE officials come for their audits, it will just be pulling documents to them for them to be able to see the right things has been put in place already.
Okay, very important to look at that, and also we will be looking at how these have played out in some of the recent tax cases that we've had ruled on in the courts in Ghana. So we selected 3 cases that we thought we should highlight around some of the happenings from a tax space and what our cherished clients and the market should be looking out for. Now, the first one is the so-called Orica case, the Orica Ghana Limited versus the Commissioner General of the Ghana Revenue Authority. Now, Orica Ghana Limited is a manufacturer. They also assemble and sell bulk commercial explosives in the mining industry. And this case is around an audit that was conducted by the Ghana Revenue Authority. And in that audit, the Ghana Revenue Authority identified that whilst the company was mainly into manufacturing of commercial explosives, they also had other services that they would provide alongside the manufacturing, such as transportation of the explosives to their various customers. And as you may be aware, the company being a manufacturing company situated outside Accra and outside regional capital was enjoying concessionary rates of corporate tax on their income. And the GRA was of the view that the income, the lower corporate tax rates should be applied on only manufacturing income and not the other services that come with the manufacturing. Of course, the taxpayer disagreed and thought that those other services should be treated as part of the manufacturing process. So whilst the taxpayer, so from the disagreement, the taxpayer then proceeded to appeal to the court, and the court ruled to disagree with the GRA, ruling in favor of the taxpayer, considering that the services are auxiliary to the manufacturing activities. So, Joachim, I would again call on you what this would mean, what would be the takeaways from this case, how it panned out, and what are the key areas, although the taxpayer had ruling in its favor, but what can businesses learn from what transpired in this?
Okay, thank you, Wisdom. So I think this was against the taxpayer. On the face of it, if you ask me, in my view, clearly separating your service activities from your manufacturing activities and your invoicing going to clearly on the face of it to suggest that you yourself know that these are separate from manufacturing activities. But that is the ruling as we have it now, and given as it may, the impact of this ruling is that if you are a business and you are set up to do certain activities, all other activities that you do will be deemed to have been conducted in a single operation. And that's why the court concluded that based on that foundation, yes, they are primarily set up to do manufacturing of explosives, but maybe these services or this transportation service are ancillary to the manufacturing activities they do. Because you ask the question, who can handle explosives better than the manufacturer? It's the manufacturer that handles it. And these are explosives. So if the manufacturer is taking additional responsibility to ensure that these explosives are transported to a place designated by the customer, then you cannot consider that as a separate activity of the manufacturer. So it was in favor of the taxpayer, and they enjoy the lower tax rates, also on the service fee as well. But businesses, we expect businesses to properly, analyze their business operations. The asset is not all activities that you do in your business that may be construed as ancillary to your services. So, for instance, if you take, let's say, you take a rural bank that have concessionary rates. So the first 10 years, either you pay 1%, the proposal you pay 5%. So you are rural bank, your business is in banking. If you go and construct offices and you rent out, we don't expect that the renting activity can be construed as having been conducted as a single unit as a banking operation. So it's not omnibus, and we have to always be aware and analyze our business situation before we apply the implications of this rule. That's very insightful and key. So my takeaway is that so it's not one size fits all. It's always important that you conduct an objective test of what your activities are and where you indeed fall. That's very insightful. And then we also have another very important case that came through in 2022, Coca-Cola Victoria Africa Limited and the Commissioner General of the Ghana Revenue Authority. And indeed, in this case, there were about 6 issues for the court to rule on, 6 very urgent tax issues that the court had to rule on. We have taken 3 of these issues to just highlight for the purpose of this discussion and also highlight what it means for business. The first issue we are looking at is around expenses relating to staff salaries paid to a service provider for the company. So a service provider outsourcing staff to the company. And as Joachim had mentioned earlier, this has been a debatable area around what the withholding tax should apply on. So in the taxpayers case, or in this particular case, Coca-Cola Victoria Africa Limited did not withhold on the salary aspect, reimbursed to the outsourcing company, but the GRA had a different view and treated the amount entirely as an expense that should attract withholding tax. We also have the issue around trade discounts to customers. Again, a very critical issue, especially in the fast-moving consumer space, where various incentives are given to customers, and there are cases where the GRA recharacterizes those incentives. And in this case, the GRA recharacterized trade discounts that the company had offered to businesses based on targets that the 8 customers, based on targets that the customers meet at the end of the year. And they are given
discounts on the sales that they have made previously. And again, there was also the issue around whether VAT should apply on various support services that Coca-Cola Equatorial Africa Limited is providing to its related party in the USA, and whether those services should be considered as consumed in Ghana, hence should attract VAT, or should be considered as consumed outside Ghana and be treated as exported services. So 3 out of 6 legal issues that the court had to determine. And I'll call on Gideon to touch on these 3 briefly, how the court concluded on these issues and what the implications are for businesses going forward.
Okay, thank you very much. I think the first one on the HR PY thing has been talked about twice, so I would go on to the next one in terms of the royalty withholding. And I think this is also quite set some of the standards in terms of the documentation needed, especially when there's a GRA audit. In terms, because in this case, the taxpayer, that's Coca-Cola Equatoria, then which I want to say is different from the bottling company, is that they had been providing certain services, so advertising, brand marketing, etc., and other support services to a Coca-Cola affiliate outside of the country. And so there had been some royalty payments, I think, on another shareholding that they owned. But the thing was that they didn't provide all the information or documentation to the GRA. And so when it went to court, the court sided with GRA in terms of that the needed documentation that the taxpayer should have provided wasn't made available to the GRA to be able to determine the right amount of taxes. And the judge also made mention to one of the provisions in the Revenue Administration Act, which says that when a case goes to court, the onus is on the taxpayer to provide evidence or proof. So if the taxpayer has not been able to provide the necessary proof, then the court will side with the revenue authority. So I think this is something that we should all be aware. When there's an ongoing audit and there's needed information or certain information asked by the GRA, please go ahead to provide. In this case, the GRA asked for an asset purchase agreement, but the taxpayer didn't provide this. They rather went ahead to provide bank transfer advice. They provided a bill of sale, etc., but not the specific information that the GRA requested. And on this basis, although I would have been interested to find out what the actual tax implication is, the judge ruled based on the technicality. The other one I think Joachim also touched briefly on that, is on a discount to commission. In this case, the Commissioner General exercises powers under Section 34 of Act 896, which says that he can recharacterize certain transactions. And so what happened in this case? So here, the judge made reference to, if you'll be aware, Fan Mill case and the Buys-Off case, which were all similar around discounts provided to an agent or a sales agent. In this case, the judge went ahead to mention for the fact that there was no mention of a trade discount on the face of the invoice, VAT invoice. And it says that the presence of a discount of VAT on the invoice is one of the cogent ways to prove that it is a discount and not a commission. And so because the taxpayer didn't mention the discount on the face of the invoice, the judge went ahead to rule against the taxpayer that, well, the GRA is right. We think this is a commission being disguised as a trade discount. I feel that, well, you could mention, or a discount provided, not mentioning the exact invoice, but maybe a subsequent invoice. The judge didn't go ahead to mention that, but one of the main reasons, or my take-home point from this, is that based on the VAT regulation, whenever you are providing discounts to your agents or your customers, please make sure that you put it on the face, you put the rates of the discount on the face of the invoice. So if you are own internally generated VAT invoice, please make sure that you add this on the face of the invoice. And the last part I want to touch on is on the supply of services consumed outside of Ghana. And this is also provide a lot more clarity on how the VAT rules applies in terms of the place of supply rules. So as I mentioned earlier, in this case, the Ghana Servicing Company has provided support services from Ghana to Coca-Cola USA. And the point of contention here is whether the service being supplied here should be zero rated or the standard rating. And if it's going to be zero rated, if it's seen as having been exported outside of Ghana, if it's not seen as an export, then the taxpayer would have been subject to further taxes because they should have charged VAT. In this case, the client didn't charge VAT. They treated this as zero rated. And so, and this, for me, this is one of the areas which went in favor of the taxpayer. The judge in this instance did not side with the GRA, but went ahead to mention that in Ghana's law, we are using the destination principle, which means they are looking at where the final services is consumed or which country, and they are going to make use of the destination principle. And they went ahead to quote the OECD VAT guidelines. And then they also talked about they made reference to a Kenyan Act, an Indian case law in this case, which I felt was very necessary and has made the place of supply rules in Ghana, as we have it now, a little bit more understandable and provided the clarity. And I just mentioned that if these services are consumed outside of Ghana, then no VAT is to apply. Unfortunately, our law didn't talk about or didn't define what consumed or used outside of Ghana is. And that's how come they went ahead to mention the Kenyan cases and the OECD VAT guidelines. And this, for me, if there is no appeal against this court, it confirms for me that in Ghana, when it comes to VAT and export of services, we have to apply the confirmation of destination principles. That means when you have an international traded service or an intangible service, the jurisdiction of the customer is to be used. So in this case, the service provided from Ghana, which is used in the US or by Coca-Cola, is not supposed to be subject to VAT. And then it's rather supposed to be a zero rated, which is also very important for the client, which means they can even deduct their VAT inputs that they've incurred here in Ghana. So these are the three areas I want to share on this case.
Right. Thank you very much. Gideon has elaborated on some of the takeaways from this case, and we've also highlighted these in the tax risk areas that we discussed earlier. So I'll move to the last case that we wanted to highlight, which is Seadrill Ghana Operations Limited versus the Commissioner General of the Ghana Revenue Authority. Again, another case that was ruled on in 2022. And basically here, the Ghana Revenue Authority had conducted audits of the taxpayer for 2012 to 2018. And a first report was issued on 8 November 2019. The taxpayer was dissatisfied, so objected to this report on the 11th of December 2019. And subsequently, there were discussions with the Commissioner General that led to a decision being given by the Commissioner General dated 11 December 2019 and served on the taxpayer, on the 1st of December 2020. But various discussions went on subsequently. The taxpayer remained dissatisfied with the outcomes of those discussions and filed a notice of appeal against the tax assessments with the High Court of Ghana on 8 November 2021. Now, the GRA filed an application to the court to strike out the appeal because the taxpayer had gone beyond the period of 30 days that's provided under Section 44 of the Revenue Administration Act for a taxpayer to make an appeal to the court if dissatisfied by the content of a tax decision after an objection. The court considered various things and ruled that the discussions with taxpayer, between taxpayer and the commissioner of the Commissioner General of the Ghana Revenue Authority could not go on end, and so ruled that the tax objection, the objection that was indeed filed by the taxpayer was in December 2019, and the taxpayer had a final decision served on it on 1st December 2020. So to wait and appeal to the court in November 2021, almost a year after, was such a long time and had gone beyond the 30 days that Section 44 of the Revenue Administration Act allowed for objection and appeal to the court. So the court indeed struck out the appeal, and that meant that the decision that the Commissioner General of the Ghana Revenue Authority served on the taxpayer in December 2020 became final. This definitely is a matter of timing, and there are interesting lessons that I believe we can take out of this in this environment of increased objections, tax audits, and scrutiny. Joachim, what are those lessons that taxpayers can take out of this?
Yeah, thank you, Wisdom. I think that for me, the great lesson taxpayers should be aware is to make up their mind early. You have to understand how the GRA work, and if you have to make an assessment of whether either you want to go to court. So once the audit is issued, report is issued, you object to the report, you wait for the GRA to respond to your objection. The court is saying that the time or the date of that objection decision is the start of the count for the 30 days to file your appeal at the court. So if you receive the objection letter, you then have to make a determination. Do you want to go to court, or you still want to engage the GRA? Because you just have 30 days window to file your appeal at the court. If you believe that you can engage further with the GRA for them to maybe consider your views on their report, there is a decision you take at the start. But you believe that it's an entrenched position, you complete or you strongly disagree with the GRA, and you believe it's only the court that can help you with the case, then you don't have to wait to discuss further with the GRA. Straight away, you have to apply to the court to appeal the case. So don't wait for subsequent correspondence. It will not help your case. You will lose the opportunity to file the case. And even though if the court will have looked at the merit of the case, the taxpayer may have won on technical grounds, the case was never heard, and taxpayer was required to settle the liability. Right. So timing is key. Timing is key, and I believe that it's also a key principle in equity. That equity will not aid the indolent, but the vigilant. So timing is key. There are specific timings provided under the Revenue Administration Act. Taxpayers should pay attention to those timings when dealing or going through objection processes when dealing with tax disputes. So I think that's very key. We'll zoom to quickly look at what the tax calendar for 2023 would look like. And I would say that this is what you should have on your desk if you are a finance manager, an accountant, a tax manager, an FC, CFO, or anyone who has responsibility relating to taxes. This is the calendar you should have. And I will not go through all, but then basically highlighting the key deadlines for filing and would usually come with payment. So we have the monthly pension contribution returns, which is 14 for the other the following month.
where 14th is a weekend, and it comes to the last working day. You have your monthly withholding tax, PAYE, withholding VAT returns, filed also 15th day of the subsequent month. But again, pay attention to when these fall on weekends. Now we have the online system that you can file, so please make sure that you are not missing your deadlines, and especially also the payments, because late payments comes with interest, and that will be a high number for your business. We have the annual PAYE reconciliation and payment of taxes for 2022. So the law allows businesses, and that has since passed by businesses, to reconcile for the year and make their payments, any differences, by the time you are filing December returns. That's also very important. Monthly excise duty, monthly VAT levy, CST. There is no reason to miss your deadline having this boldly printed on your desktop, or if you're keeping the environment, as I would suggest, keep this somewhere, keep it even as your desktop background. You have your self-assessment, and this is based on the assumption for a 1st January to 31st December accounting year period. If your accounting period is different, then this would change accordingly. But then we are looking at 1st January to 31st December financial year. So you have your self-assessment, employers' annual deduction schedule, which we tend to miss a lot of times. By the end of April of every year, we file for the prior year annual personal income tax returns, annual corporate tax return due for 2022. If you can't meet it, apply for extension. Then we have the Office of the Registrar of Companies annual return filing, and you should be doing that for local file and master file transfer pricing documentations. If you have transfer pricing issues, or you have related party transactions, by end of April, if you can't make it, you put in an application. You have your self-assessment, quarterly self-assessment also coming through. You have your self-assessment payments for the 4th quarter, end of December. Again, a very, very critical date, because by these dates you should have revised or assessed your provisional assessment for the year, and make sure that whatever you are filing do not fall foul to the 10% margin of error rule, and you avoid paying under provisioning interest. So this filing date, self-assessment payment or final revision for the year 2023 will be very important. Speak to your taxpayer, keep this on your calendar. Then CBC reports and notification for 2022. CBC is country by country reporting from a transfer pricing point of view. You have 12 months after the end of the year to file this with the transfer pricing unit of the Ghana Revenue Authority. For 2022, this will be end of the year 2023. Another area that we should really pay attention to. If you are not compliant with your transfer pricing report, master file, local file, speak to your consultant and have that in place, because now you file actually with the Ghana Revenue Authority, and at the end of the year, you file country by country report. So we'll go into take some of the questions that you have brought to us. We have tried to answer a number of them live. We'll take a few of these questions also and try to address them. So we have So the first one is mainly a comment. So we had one where we have a minute. Let me take that. So we had a comment around the abolishing of the benchmark policy and comments around whether this is sustainable. I believe that is a general comment that is coming through, but the question is how sustainable is local production. So where you are having a hit on importation costs, to reversal of benchmark value discount policy, increased import cost. The idea is to eventually lead to high local production. The question is how sustainable are we and our manufacturers ready to produce? I believe that that is a question for all of us to answer, but importantly, we would need to get our policies right to incentivize local production, local manufacturing, to close the gap where we have gaps in the supply that potentially will be reduced from imports. The other question was to highlight more on the self-clearing of goods. So I'll call Joachim to just in a minute highlight on the self-clearing of goods, what this means. If you can just give a bit of explanation, and also I'll add this: can we have more elaboration on how importers can avoid the 1% IRS tax deposits? Because this person mentions that his company always provides tea, but they do not get the exemption. If it's something that you should be contacted and spoken to, please let me know. But so Joachim, please take these two together, the self-clearing and then the 1%, and to take a brief comment on the implications of government debt exchange program.
All right, thank you. I think the self-clearing, because it's a new initiative that has come on board, we expect the GRA to come out with operational guidelines on how companies can now, register on the portal. But we expect that there will be registration on the portal. The icons that will give access for people to register their business for the self-clearing. It's still new. We don't have a lot of information on it yet, but we expect that to be on the icons and then to allow for companies to directly register and get their business. On the IRS tax, I don't know whether your agent are able to provide this when they are doing the clearing on your behalf. Where we expect that once this data are provided during the declaration phase, the tax should not be applied. So maybe we have to speak more to our agent to see when you provide them, do they provide these things in the declaration process for the custom for consideration during the process. Sometimes they will not provide, and that's why we may have to suffer the taxes. We know taxpayers who don't suffer these taxes when the thing is provided for declaration. So more consultation with your agents and let them be aware. The reason why you are giving out this thing for their consideration in the current process. Please now you're on mute. Please unmute.
Right. Thank you very much. I hope you can hear me.
Yes, Wisdom, we can hear you now.
Okay, right. So we also had a question around whether a company has to pay VAT on invoicing a cooperative society. So farmers cooperative. I believe that this will be based on what you are invoicing. If you are invoicing a taxable supply, then you would have an obligation to charge your VAT. If the recipient has any form of exemption, and there are procedures to get the relief from the tax authority. We also have a question. So again, the IRS question keeps coming up. We also have a question where, so I think based on the Coca-Cola ruling, Bismarck is asking if payments to parent entity for office rented here, phone bills, water, canteen, whether those billings should attract VAT. So again, you may take that. I don't know whether you fully understand that. So you may take that, but of course, I believe that the situation always differ. So in all cases, we would have to look at the surrounding circumstances in detail to conclude. So I think maybe you can have a comment there. Then I'll call Gideon to speak to whether there are any tax implications for the current debt exchange program that's ongoing.
Okay, so rightly so, this is a specific case based on specific circumstances. So in as much as it tries to address certain general principles, I think its application will be specific to each entity. So billing your parent company for office rent, utilities. So the question I'll ask is, what are you providing for your parent company? Are you providing certain services for your parent company? How is your income generated? You earn income on the markup, for instance. So if you earn income on the markup, then all these costs become your input before you apply your markup. That becomes your revenue. And to the extent that the activities or the service you are providing for a company, parent company, is subject to VAT, then VAT will apply on all these utilities, rent that you are seeking reimbursement for. So it will still be on a case-by-case basis, and each business have to assess the specific agreement, the specific activity they are undertaking before they can make a good determination on whether or not they have to charge VAT or not charge VAT.
Okay, right. Thank you very much. And there was also a question, someone talked about the VAT on electronically supplied services. Sorry, Gideon, I'll call you in a bit. So electronically supplied services. So from last year, which is 2022, the GRA allowed a mechanism for non-residents to charge VAT on electronically supplied services for use and enjoyment in Ghana. So yes, if you are seeing VAT on services provided electronically from non-residents, then that is the reason, and it's allowed under Section 16 of the VAT Act. If you're paying a non-resident for services, then your obligation in relation to withholding tax is under the Income Tax Act to withhold if the service fee has its source in Ghana. The GRA has explained that source in Ghana means where you bear the cost in Ghana. So yes, in general, based on the GRA's practice notes and the law, you would have to withhold when paying on the debt exchange program currently ongoing, situation that remains fluid. Yeah. Hello, Gideon, you're on mute.
Okay, so in fact, I was actually providing a response, and I think this is a very topical question, especially on the debt exchange program. And I'll just give general comments on that, but it's also very relevant that as you are looking at it, we have to consider the regulatory oversight body in terms of the guidelines that they have provided. Because I know in the past, as an example, if it's a banking or financial institution, for example, regulated by the bank of Ghana. Then the Bank of Ghana's guidelines, GRA has in times past relied on the Bank of Ghana's guidelines to be able to provide or use that as a basis for a tax deduction. However, under the current law 896, if you're a bank, for example, and you have a specific provision, the law allows for that debt to be
Hello, Gideon.
for your books. I think that should provide you some ways to look at it in terms of getting a deduction. So it's not solely clearly straightforward. You have to consider the Bank of Ghana guidelines, or if you're an SEC regulated body, what the guideline says, and whether this will be seen as a specific provision for you, the bank, or the investor, or depending on the corporate body. As it is now, for individuals, the law does not allow for the tax law does not allow for individuals to deduct anything especially against their incomes. So for individuals, if you're in this case, I'm sorry, you are in a hard luck, unless maybe as part of this debt renegotiation regime, a specific tax provision is made for it to allow individuals in some way. I would think if they allow them to file returns, or say you'll be allowed to get some deductions going forward. So it's a lot more early stages yet, but I'm sure as time goes on, there'll be more clarity brought to this case.
Right. Thank you, Gideon. So there are several questions that we've tried to answer live. The ones that are pending, we'll take them and answer back to you directly. We have some 5 minutes to go, and would like to move to George, can you hear me?
Hello, Wisdom. Okay, I didn't hear you. I can hear you now.
Yeah, right. So we are all yours.
Okay. So thank you very much for joining the session. What we have now is that we have something new that we want to introduce to you, and so please stay on and just take part of this section. It's a wonderful section we are going to have. Now we want to introduce to you what we call Deloitte Tax at Hand. Deloitte Tax at Hand is an app that we use. You can put it on your mobile phone. It can be on your laptop. Maybe let me just show you this one. Okay. So it is a mobile app, or it's something that, like I said, you can put on your laptop. Very convenient. You are able to get information regarding tax information globally, not just in Ghana. You can also have the opportunity to interact with professionals globally as far as tax is concerned. You have information on ongoing basis. And so every country that you select that you want to get tax information on, you are able to get this on your phone. Any update that comes, you get it, an alert on your phone, and you are able to also share with your friends. You are able to save various tax topics, and then you can read subsequently. You can also have the opportunity to even customize your own page and then select which topics you want to get updates on. You can select which countries you want, the language you want, and then share on other social media platforms. And so it's a convenient, very highly interactive platform, and connected to, like I said, professionals globally. It is a global platform that we have here. And so I'm going to give you the opportunity to have this on your phones or even download it on your laptops, and then you can use it. You can get interactions with people. You can ask questions, and then people will be able to assist in responding to the questions that you want to know, you want to get updates on. For instance, some of the topics that we have discussed here, the updates that we have done as far as Ghana taxes is concerned. If you select Ghana, for instance, then you are going to be able to have the conversation as far as that is concerned. So this is the app. I'm going to take you through how you can access this on your phone. So let me quickly take you through the process. You take your phone, you just take a screen of this, and then it will be on your phone. You go through the process to register on yourself, so that you can have your own email where you use to get the notifications, and then also you can have your alert on your phone. Okay, so let me quickly share with you how you can access this as quickly as possible for you to enjoy it. Just give me a second. Please let me know if you can see my screen.
Yeah.
Can you see my screen?
Yes, your screen is big.
Okay. So when you log in to the platform, you register. This is where it takes you. So for instance, I have decided to choose Ghana. So once I've chosen Ghana, I see whatever. So some of the topics we discussed, the changes to VAT and e-levy rates effected is here. The webinar we discussed is here. You can have it. Key tax highlights for 2023, budget statement, corporate tax is here. And then you can come here again and decide that, okay, I want to get updates, or I want to get information for, let's say, Kenya. So you pick Kenya, or let me use Nigeria for this purpose. So I select Nigeria. Good. And then you're able to get whatever information that you like to have as far as Nigeria is concerned. You also have the opportunity to personalize your own page. So you come to this site, it's a personalized homepage. So I come here, then I would decide on, okay, so this is me. Let's just go. I want to go to the personalized page, and then is something not working here for me?
Yeah, please click there. You have read and accept.
Yes. Okay, thank you. Okay, so you should be able to take me to the page. Just a moment. Is anything the problem, because I just did it?
I think it's
Let
not
me try it again. That page is not. Let me try it again here.
Yours already.
Sorry.
So George, it's because you personalized yours already.
Yes. So let me do this again.
So once you're on the page, yeah, you would be able to.
Is this one? Are you seeing this one?
Yes.
I see my screen. Okay.
Yes, we can see your screen.
Okay.
We can see your screen, but
Okay,
you have
so
personalized yours already. So
yes,
and that is it. So your function, the industry,
exactly.
and all that
So,
help to curate what is delivered to you.
Exactly. I want to do that again, and then they can enjoy how the app works. But if you have already downloaded it, you'll be able to go through.
Exactly.
So yeah, I'm going back to be able to get it so that you see the process. Very simple process, and you get all that you want to get. Okay, so I personalized my page. So I said I want Ghana, I want Nigeria, and then I want South Africa. I can always go back to which jurisdictions I want as well. Okay, so these are the jurisdictions that, or the topics I choose first. So I choose business tax, I choose cross-border employment tax, I choose indirect, individual taxation, transfer pricing. You can always, like I said, go back and then edit your personalization to choose which ones you want to select, depending on the country and the language that you want to use. Very interactive. Okay, so you come here. Can anybody tell me which country he or she wants? These are the countries I've selected. If you want, I can add Kenya here because I've added to it. Okay. And then there we go. Just a moment. Sorry, I added Kenya to my page. And I want to add more to my page so that I can easily share. Okay, it was hiding. Apologies, the screen was hiding. So, okay. So I added that to my page, and then I can go back and do whatever I wanted to do on my page. I don't know why this is going this way. Okay. Okay, so it brings me to the page that I selected. Okay, so all the information that you want, you now can get it from the page, and that is how this app works. Okay. So I don't know if anybody has been able to download it, and then you can go through.
Yeah. Okay.
Has anybody downloaded?
So the new page you were showing earlier, we could not see it, but then I just tried the download and I could follow what you were doing. We still had the save changes page, but I could.
So you cannot see my page as I speak?
Yes, but then I followed and I was able to follow and personalize my own page. Yeah. So George, I think that so we can go to the page where we have the QR code.
Yes, I want to go to that page. Just give me a second. Let me pull this one down.
So I'll share that for you.
Okay.
I'll share that for you. Right. I believe it's up and you can see my screen now.
Okay, so that is the screen there. So people can try it, and then we see how it works on your phones.
Okay. So George, I'll keep this here whilst we take the closing remarks from you.
Okay. All right. So thank you very much. And I want to again say thanks to everyone for participating in this year's Tax Outlook 2023. Like the discussion went, there has been a lot of changes to the tax regime. Some have been passed, some are still in the offing. We are looking forward to those ones to being passed. But as you get to know what the outlook is, then that will guide you as far as the run of your business is concerned. We have also discussed issues around tax audits and what you need to do, given some of the case laws that, or the cases that have been heard by the courts and the positions that were taken to serve as a guide on the need for processes that you need to put in place, or the need for documentation, and even the timing of responses that you need to put in place. All these are to help you to ensure that you work within the provisions of the tax law. Interesting questions that have come around the debt exchange and all that. We believe that by the time it's concluded, this debt exchange is concluded, there would definitely be some guidelines as to should there be losses being incurred as a result of some of these positions or some of these policies that have come to play, how from tax perspective we are going to treat it. There may be some experiences we can learn from some other jurisdictions, which will help the government in coming out with policies around it. And so this year, we will also be sharing with you our tax training calendar, so that you know the various topics that we'll be treating in the course of this year. Once you also have this app, you'll be able to get some of these notifications, like I mentioned, on your phones and on your laptops, to be able to be part of our interactions as far as tax issues are concerned in Ghana, and even where you have multiple jurisdictions where you treat, you'll be able to get information on what is happening across. You can select a region that you want, like I said, if you are working within Ghana, Nigeria, Kenya, South Africa, you always be able to get updates on topics as far as tax is concerned and latest information is concerned. So I want to say once again, thank you very much for joining this section, and see you during our next tax updates.
Thank you very much. It's bye from us. Have a good afternoon.